There is one number that right now is holding the entire gold market together, and it is minutes away from cracking. Gold is sitting at $4,208, barely $5 above the critical $4,203 support. The dollar is ripping higher on the most hawkish Fed signals we've seen this year. Real yields are surging, and the fear architect, gold, is starting to tremble. Most traders are looking at this and thinking support will hold. They are about to walk into a trap. I'm going to show you the danger zone, the hidden opportunity, and 3 exact trading setups you can use right now, including the level that, if broken, turns this into a freefall. Stay to the end because I'm giving you the sniper entry, the active play, and the high-risk aggressor move with exact numbers on screen. Here's your instant market verdict. Gold is in a strong sell structure across every short-term time frame. Weekly chart, strong sell. Daily, strong sell. 4-hour, strong sell. 1 hour, strong sell. The only outlier is the monthly, which still prints a strong buy, but that's the longer-term architecture, and right now the short-term momentum is crushing it. The session bias is fading any bounce and selling into strength. We are range-bound between 4,203 and the 4,293 pivot, but the tilt is aggressively lower. Write this number down. 4,203. If we get a 4-hour candle close below 4,203, the entire structure resets, and we open the trapdoor down to 4,129 and then 4,039. That is the invalidation line that flips this from a controlled sell-off into a full-blown liquidation cascade. Right now the herd is positioned long. Retail sentiment shows a majority buying the dip, expecting the monthly support to hold. Institutions are offloading. ETF flows have turned decisively negative. Over the last 48 hours, we've seen the largest daily outflow from gold ETFs in 3 weeks. That's smart money reducing exposure. The commitment of traders' data shows that managed money has flipped net short in the futures market for the first time in 2 months. So the fuel for a sharp breakdown is fully loaded and the crowd is standing on the wrong side. Let's go top down. On the weekly chart, gold has formed a massive bearish engulfing candle from the 4,500 area, slicing through the 20-week moving average like it wasn't there. The 60-week moving average, our institutional anchor, is at 4,511, miles above current price. The 200-week moving average is sitting right at 4,370, acting like a brick wall that price failed to conquer multiple times over the past month. That 4,370 level is where the bulls lost the battle and where the bears established control. Weekly MACD just crossed into negative territory. That's a momentum kill signal that doesn't reverse quickly. So any bounce toward 4,370 will meet heavy, institutional-grade selling pull up the daily chart. Gold is trading below all major moving averages. The 20-day at 4,351, the 50-day at 4,511, the 100-day at 4,544, and critically, the 200-day at 4,370. That cluster from 4,351 to 4,370 is a resistance fortress. Daily MACD is deeply negative at -91 and accelerating lower. The histogram is not turning up. There is no bullish divergence. There isn't even a hint. RSI at 37 is not yet oversold, meaning there is plenty of runway for further downside before the market gets stretched. The ADX, the trend strength indicator, sits at 37. That's above the 25 threshold, confirming a strong trend. And the trend is down. Daily support sits at exactly 4,203, our S1, then 4,129, and finally 4,039. Resistance is 4,293 pivot, then 4,367. The pivot at 4,293 aligns perfectly with the daily value area low from last week's breakdown, making it the line in the sand for any short covering rally. As long as gold stays below 4,293, the bears are in absolute control. Here's what most traders miss. The 4-hour chart is showing a textbook negative divergence against the minor bounce we saw yesterday. Price ticked up to 4,230, but the MACD histogram barely moved. That's exhaustion. Buyers tried to push and got rejected right below the 4,293 pivot. Since then we've rolled over again, and the 4-hour strong sell signal is fresh and accelerating. The 60-minute chart is also in strong sell, with price hugging the lower band of a descending channel. The moving averages on the 60 are all sloping down. MA20, MA60, price is pinned below them like a lid. So the intraday structure is a bear flag that could resolve lower at any moment. The ATR, the average true range, is $120. That means we are in a high volatility environment where moves can overshoot both directions. That volatility is a weapon. Use it to your advantage but respect your stops. Now let's talk about what's really driving this. The fear architect, gold, normally thrives on panic. But right now, all the fear is flowing directly into the dollar. The dollar index has surged above 105 and it's holding, while the 10-year real yield has spiked to levels we haven't seen since the last brutal gold sell-off. Gold moves tick for tick with real yields inverted. When real yields rip, gold gets crushed. The correlation is near negative 0.9 right now, one of the tightest linkages in months. Every basis point higher in real yields is a hammer blow to gold's safe haven premium. And yet, some traders are still trying to buy gold because of geopolitical noise. That's the trap. The geopolitical bid is dormant. The market is pricing in a de-escalation premium, not an escalation. Until we see an actual supply disruption or a sovereign debt shock, the haven flows go to the dollar, not gold. Now connect the dots across assets. Bitcoin is also under pressure, tracking the S&P 500 futures. The risk asset shadow is heavy. When equities get hit and the VIX starts to stir, gold initially can catch a bid. But if the sell-off deepens and liquidity tightens, gold often gets liquidated to cover margin calls. That's exactly the setup I see shaping up. Crude oil is relatively calm, so there's no inflation panic bid. The cross asset signal is unified. Risk-off is dollar bid, not gold bid. And that is a toxic environment for gold bulls. Let's digest the last 24 hours. A parade of Fed speakers, multiple voting members, delivered a unified hawkish message. They explicitly pushed back on any near-term rate cuts and hinted that the next move could still be a hike if inflation doesn't roll over. The market got caught leaning heavily short dollars and long gold. That positioning got annihilated. Gold dropped sharply, but it didn't collapse yet because of the 4,203 support and some quarter-end rebalancing flows providing a temporary floor. But that floor is fragile. The market is now repricing the rate path, and the probability of no cuts until the fourth quarter has jumped to 70%. That's a huge shift in just 2 days. The analyst consensus is that gold is stabilizing after the hawkish shock, but I see that stabilization as a bear flag, not a reversal. The price action is giving every dip buyer hope while smart money distributes into that hope. Then why 1 to 2 week directional lean is bearish with a primary target of 4,129 and a stretch target of 4,039. The one level that invalidates this entire bearish thesis is a daily close above 4,370. If gold can reclaim and hold above the 200-day moving average, then the monthly strong buy comes back into play and this bearish structure crumbles. Until then, the bias is sell rallies. So let me ask you now, do you think gold breaks 4,203 this week? Comment yes or no right now. I'm tracking consensus and I'll reference it in tomorrow's video. Most people skip this trade setup section. That's exactly where the money is made. Keep watching. I'm laying out 3 distinct trade plans with exact entries, stops, and targets on your screen. The first one is the sniper, the conservative play. The second is the active trader, the standard momentum continuation. The third is the aggressor, a high-risk counter-trend bounce. Every single one has a clear invalidation condition so you never guess. Strategy number 1, the sniper. This is the conservative short, waiting for a pullback to sell into strength. Given the powerful bearish momentum, we don't want to chase breakdowns. We want to sell the retest of resistance. The sniper will look for a rally toward the 4,293 pivot level. which aligns with the top of the hourly bear flag and the intraday value area high. Entry condition: a 1-hour candle close above 4,285 but with a clear rejection wick leaving a bearish pin bar, then a short entry at 4,293 with a limit order. Stop loss goes at 4,375. That's above the brick wall 200-day moving average at 4,370, giving you breathing room to avoid noise. Take profit 1 is 4,205, just above the current support, banking on a test and near crack of 4,203. Take profit 2 is 4,130, the next support floor. Risk to reward on this play is 1 to 1.1 on the first target and 1 to 2.0 if you hold for the full move. Invalidation: if the daily candle closes above 4,370, this sniper idea is void. We step aside. This is a high probability, lower frequency setup that lets you sell the rip with the trend, the sniper, conservative, entry. 4,293, 1H close above 4,285 with rejection, stop loss. 4,375 take profit 1. 4,205 take profit 2. 4,130 risk, reward. 1 minute and 1.1 second, TP1. 1 minute and 2 seconds, TP2, invalidation. Daily close above 4,370 strategy 2, the active trader. This is the standard momentum continuation play for those who want to participate without waiting for a deep pullback. The plan is to catch the breakdown of 4,203 on a confirmed signal. Here's the trigger: a 1-hour candle close below 4,200. That's a break and a psychological trigger. Entry right at market after that close. But we wait for a quick retest of the broken support as new resistance to confirm sellers are in control. So if we close below 4,200 and then price pokes back up to the 4,203 to 4,205 zone and shows a bearish rejection, you enter short with a stop at 4,240, above the recent intraday swing high and above the 60-minute moving averages. Target 1 is 4,140, a clean level just above S2. Target 2 is 4,045, near S3. Once target 1 hits, trail the stop to entry to lock in a risk-free trade. Risk is about $40, reward to T1 is $60, 1 to 1.5, and to T2 it's $155, or 1 to 3.9 reward to risk. That's an excellent asymmetric opportunity. Invalidation: if the breakdown fails and price recaptures 4,260, the pattern breaks and you exit without hesitation. This play relies on momentum, so if the breakdown lacks follow through, you're out. The active trader, standard, entry. 4,202 on retest after 1 hour close below 4,200 stop loss. 4,240 take profit 1. 4,140 take profit 2. 4,045 risk, reward. 1 minute and 1.5 seconds, TP1. 1 minute and 3.9 seconds, TP2, invalidation. Recapture of 4,260. Before I reveal the aggressive play, I want you to type your XAUUSD range for tomorrow in the comments. Do you see 4,150 or a bounce to 4,300? Let's see who's aligned with the institutional flow. I'll read them and give a shout out in the next session. Strategy 3, the aggressor. This is high risk, counter trend, and only for those who can lose small and manage risk aggressively. The idea is a precise bounce trade at the 4,203 support, betting that the monthly support holds for one more fakeout before the real break. The trigger, a bullish engulfing candle on the 15-minute chart right at the 4,205 to 4,210 zone, with the 15-minute RSI pushing back above 30 from oversold territory, a momentum snap. Entry long at 4,208 with a very tight stop at 4,185, below the recent low and below the psychological 4,200 handle. Take profit 1 is 4,250, the top of the descending bear flag channel. Take profit 2 is 4,290, the pivot. This is a quick scalp with a risk of only $23 and potential reward of $42 to $82, giving a risk to reward of 1 to 1.8 on T1 and 1 to 3.6 on T2. But be warned, This goes directly against the daily and weekly strong sell trend. If 4,203 breaks intraday without a bounce, you will get stopped out. No confirmation, no trade. Invalidation. Is a 15-minute close below 4,200? That voids the bounce thesis immediately. Only the nimble, only those who can cut a losing trade in seconds, should touch this. The aggressor, high risk, entry. 4,208, 15 minutes bullish engulfing at 4,205 to 4,210, stop loss. 4,185 take profit 1. 4,250 take profit 2. 4,290 risk, reward. 1 minute and 1.8 seconds, TP1. 1 minute and 3.6 seconds, TP2, invalidation. 15-minute close below 4,200. Here's your risk management pulse. 30 seconds that will keep you alive. Never risk more than 1 to 2% of your account on any single trade. Position size based on the stop distance we just laid out. No positions through high-impact news. The Fed speakers today could drop an unexpected line and gap the market. Stops are non-negotiable. If your stop hits, you're out, you reassess, you survive. This is how you trade the next big move instead of watching it from the sidelines with a blown account. Now let's wrap this up and create the retention loop. The single most critical level for the next session is 4,203. A 4-hour close below it and we are in freefall toward 4,129 and potentially 4,039. If it holds, we might see a messy, sloppy bounce toward the 4,293 pivot, but sellers will be waiting there like a coiled spring. Tomorrow I'm laser-focused on the US existing home sales data and another round of Fed speakers, including a key hawkish governor. Any further hawkish surprise could be the exact catalyst that cracks the 4,203 support and triggers the liquidation. For the full breakdown on Bitcoin and the S&P 500 divergence, that video is live right now. Tap the end screen on your screen. If this plan gave you a clear edge, smash the like button, subscribe, hit the bell, and I will see you in the next one. This is Alpha Market Meridian. Trade the levels, not the noise.